Net Wealth Investments Limited is licensed to provide general advice. Our podcasts are not tailored to any one financial situation and may contain views of our presenters which may not align with Net Wealth's. The guests' organisation and Net Wealth have an arrangement for their financial products to be available for investment through the Net Wealth platforms, and Net Wealth may receive fees from the guest. More information about Net Wealth can be found on our website, including our financial services guide and disclosure documents. Please seek professional advice before acting.
Welcome to the Net Wealth Portfolio Construction Podcast, brought to you by the Net Wealth Investment Research Team. In this podcast series, we pick the brains of key wealth management professionals to uncover opportunities and challenges for investors on a diverse range of topics. We hope you enjoy their unique perspectives.
Welcome to the Net Wealth Investment Podcast series. My name is Paul O'Connor and I'm the Head of Investment Management and Research. Today we welcome Arnaud Brillois from Lazard Asset Management, who is a Managing Director and Portfolio Manager and Analyst on the Global Convertibles team. Lazard was established in 1953 and was privately owned until listing on the New York Stock Exchange in 2005. Lazard is a major global investment manager with almost 300 billion AUD in assets under management, invested across a range of global, regional and country-specific strategies, both traditional and alternative in listed equity and fixed income. The firm now operates from 24 cities across 17 countries and has over 800 staff globally. Arnaud began working in the investment industry in 2000 and joined Lazard Gestion in 2008 and was head of convertible bonds and co-head of alternative and structured products before relocating to New York with Lazard Asset Management in 2017. Prior to joining Lazard, he was a director of Alpha Bonds and Convertible Bonds Management at Natixis Asset Management. Arnaud is a graduate of the ISCID and is a CFA charter holder and a member of the French Society of Financial Analysts. The Lazard Global Convertibles Fund is an actively managed convertible bond portfolio that typically holds between 60 and 80 convertible global bonds that are selected from a universe of approximately 1,000 securities. The investment team employs a fundamental bottom-up approach that utilises rigorous qualitative and quantitative analysis to drive security selection, complemented by a top-down process that guides tactical positioning across the portfolio. Given Arnaud's role is on global convertible debt, we'll focus today's podcast on convertible bonds, including what are they, what are the risks, and how they can be used in a diversified portfolio. Convertible bonds are a hybrid type security that are issued as a bond but can be converted to equity or shares, but we will allow Arnaud to elaborate. It'll also be interesting to understand how convertible bonds performed during 2020 and what's the outlook for issuance in the market. During 2020, interest rates continued to fall, so the other point to discuss today is whether convertible bonds can play a role in providing reliable income into a portfolio, and can they be an alternative to traditional bonds. So, welcome to the Net Wealth Investment Podcast, Arnaud, and I hope that you and the Lazard Global Convertible Bond team are all well. But has your workplace returned to any pre-COVID normality, and is the team all back in the office during the week?
Hello, Paul, and hello, everybody. I'm very happy to talk with you today. In fact, in New York, only 10% of workers are back to their office, but in my team, it's very close to be back to normal. 80% of my team is coming back to the office on a daily basis. So little by little, that's why I'm so optimistic, but because little by little, we are coming back to normal, and everybody is safe.
That's great to hear, Arnaud. We're slowly readjusting and moving back to normality, or whatever that will look like in Australia now. So it will be interesting, but I think the workplace has changed permanently in terms of that working from home and working from the office balance there. So Um, Moving into the podcast and the topic of the podcast, and before we get into convertible bonds, what's your view and your thought on the outlook for the global economy in 2021, and what concerns you the most about the year ahead? And perhaps is it interest rate rises driven by inflation or further COVID-related problems continuing to slow the global economy, or even geopolitical risks on the horizon?
Oh, so I'm going to talk a little about equity, credit, interest rate, because they are some constituent and a part of a convertible bond. So I would say that we remain positive and optimistic on the performance of equity markets in 2021. In fact, we believe that equity markets will be supported by the first signs of a return to normalcy as vaccines are being rolled out and consumers start unlocking the vast amount of savings accumulated during the crisis. Between the US and Europe, we do not anticipate a significant outperformance of one region against the other, as the high level of innovation and growth in the US will be matched by a recovery from higher valuation discounts in Europe. However, from a sectorial perspective, we anticipate high level of rotations between technology and recovery sectors, for example. It will necessitate an active allocation and positioning on a sectorial basis. On the credit, we anticipate that credit markets remain supported by a recovery of the equity market, in particular in the context of strong liquidity and financial support provided by accommodative central banks across regions. While interest rates, like you mentioned it, have been trending higher across regions in 2021 so far, it should be put back into perspective as, for example, the US interest rates are just back at the pre-COVID levels, an already low level of interest rates historically. Eventually, we anticipate stronger intervention from central banks should interest rates continue their ascent. This is particularly true in the context of a global inflation that remained subdued and still well below the targeted levels of American and European central banks.
Yeah, it has been interesting. I mean, the whole issue, I guess, of interest rate rises, and I guess we've all noted the rise in the 10-year bond yield in the US and also in Australia. So, do you see the longer term dated bonds continuing to trend up, the yield on them?
I think that the central banks will let the interest rates to go up till a given level. For example, the Fed has not only to be careful about inflation, but they have to be careful about employment. And the unemployment level stays very high. And the cost of refinancing is going to become higher and higher and will decrease the potential refinancing credit of a company. So uh, we believe that it's going to continue to go up. But for example, for the 10-year US, at one point when we arrive around 190% or 2%, suddenly the Fed will start to change its speech and his way of seeing interest rate and may intervene in order to keep it at a lower way to be sure that it won't impact a part of the economy. So at the short term, yes, I believe that it's going to still go up, but at one point it will stop.
Yes, well, I guess it's positive overall, the fact that we're getting more of a normalisation of the yield curve there, Arno. But we'll get into the convertible bonds anyway. So, for the benefit of some of the listeners, could you explain what is a convertible bond, and perhaps give just a couple of comments about their history, such as how long have these securities been issued by companies?
Oh, Paul, don't worry. I'm not going to give you all the story of convertible bond because, in fact, many investors have the belief that it is very fresh, that it is very new. But in fact, convertible bonds have a long history. They were created back in the Middle Age in Italy by the Medicis, and later they have been used as a financing tool by the US railways, barons during the Industrial Revolution. They did a comeback in the 80s and have since then grown in popularity. To explain how a convertible bond is working, first I would say that it is a simple and standardized product. First and foremost, it is a bond. So it has a maturity, it has a coupon, it has a reimbursement at maturity, all organized in a normal prospectus. But there is something extra in the prospectus. The holders can convert into stock at a predetermined price. It is called the strike. So if the underlying equity has been rising, it will be more interesting to convert to realize a profit. And if the underlying equity has been falling, then we will ask to get back the cash, and we will add all the coupons and the yield to maturity.
So how does a convertible bond differ from vanilla equity or debt? And are they simply debt securities until they convert to equity?
In fact, convertible bonds have sensitivity to a much broader range of factors than vanilla equity or debt. Compared to equities, they are both sensitive to the equity price, of course, but convertible bonds will also have sensitivity to the equity volatility. The more equities are volatile, the more the option included in the convertible bond is valuable. Compared to vanilla debt, they will also have sensitivity to credit spreads and interest rates, but with an average modified duration that is quite low, around 2. The convertible bond market is usually less sensitive to increased interest rate than the credit market. Also, convertible bond can benefit from specific clauses. For example, a frequent clause in the prospectus is called takeover protection. It will provide an extra return for convertible bonds holders should the company is the target of a takeover bid.
It's interesting there as you're talking, Arnaud. I'm just thinking to myself, so to be an analyst and a portfolio manager of a convertible bond portfolio, you've almost got to both be an equity analyst and have equity analytical skills, but also have the traditional credit analysis skills there. So it must be a fairly dynamic part of the market to study and to try and value there. So it'd be interesting the type of staff and the background that you employ in your team to be able to support that. Most investors are positioning their portfolios to have a minimal exposure to duration. So as convertible bonds are typically low duration instruments, how does their duration compare to, say, the high yield market or credit securities?
Convertible bonds modified duration is structurally low, around 2, and convertible bonds have typically very well reacted during an environment of rising interest rates, because most of the time when you have rising interest rates, you have rising equity markets. So the equity part of the convertible bond is going to compensate for the impact of rising interest. Since 1999, there has been 9 years where the US 10-year rates have risen. And out of these 9 years, 8 years, the convertible bond market produced positive returns. So indeed, convertible bond behave very well during rising interest rates.
Something unique to convertible bonds is convexity. So can you explain convexity and what are the benefits for investors?
Convexity is the magic word of the convertible bond universe. So, in fact, the structure of convertible bonds creates a very specific payoff profile. When equity prices are rising, convertible bonds are capturing more and more of the upside, allowing them to participate greatly to the upside of equities. And when equity prices are falling, convertible bonds become less and less sensitive to the equity prices, as their bond components creates a cushion. These characteristics makes the payoff of convertible bonds very convex, in particular during volatile markets.
So what attributes are you looking for in a great convertible bond investment, and how is your approach similar or different to what an equity or a bond investor might do?
In fact, first, we want to make sure that the credit is sustainable to avoid any defaults. A convertible bond is a bond, so you have to focus first on the credit side. Second, we want to make sure that there is high upside potential on the underlying equity to be able to provide strong positive returns. Third, we use quantitative analysis to make sure that the convertible bonds offer the quantitative aspects that we are looking for, such as high convexity. It is very interesting asset class, but it necessitates a constant monitoring because of the clauses in the prospectus and all the corporate actions that they have during their life.
Before we bring you the second part of this chat, a little bit about who we are. Netwealth is an ASX-listed company established to help Australians take control of their financial futures. With a wide range of super and investment accounts, a huge variety of investment options and market-leading online tools, we can help you manage your wealth your way. Partner with us to see wealth differently and discover a brighter future. Visit the Netwealth website to learn more and get the PDS, which you should read before making a decision. Products issued by Netwealth Investments Limited.
So it sounds to me that the analysis begins with looking at the bond like a traditional fixed income security, and can the company pay the coupon? Can I get my capital back? But then I guess when you're looking at the upside, you're thinking more like an equity analyst in terms of the optionality and the convexity you explained earlier, Arnaud.
You're totally right, and that's very funny that you stress that part and the fact that you have to have a complete view on one issuer, not only on the equity part, but on the credit part, on the volatility of underlying equity, on the clauses, because that's why I decided to manage convertible bond 20 years ago, because it was an asset that was giving me a broad view on one company and on the global financial markets.
To understand the issuer risk in a little more detail, what type of companies issue convertible bonds? And is there a bias potentially to the high yield sector, or with sub-investment grade credit ratings, or do higher quality companies from an investment grade perspective also issue convertible bonds?
In fact, convertible bonds are mostly issued by mid-caps and growth companies, in particular in the technology and communication sectors. This means that they benefit from the changes of consumption patterns that have emerged in 2020, while offering a dynamic growth profile by their smaller capitalization. These companies typically issue only convertible bonds and therefore do not have the need to have rating agencies providing a rating. As a consequence, more than 60% of the convertible bonds in our market are non-rated. We also have many convertible bonds in our space that are in sectors that have suffered from the COVID-19 crisis, such as issuer linked to tourism, airlines, transportations, events. These companies are particularly cheap as of now and offer good upside in our view.
So in terms of the credit risk, then, if a lot of the companies don't have ratings from credit rating agencies, does your investment team undertake, I guess, a shadow credit rating analysis of the inherent credit risk in a convertible bond?
We have to, as there are a lot of non-rated convertible bond, we have to do a specific study of a credit, and we have to create some internal credit rating just in order to monitor the credit risk in our global portfolios. So we are doing the normal credit analysis, and in the current market, as we are focusing a lot on the recovery companies, we have been incorporating new rules. For example, we are not investing in companies that have less than 14 months of cash at the current cash burning rate. So that's credit is very, very important. and I joined Lazard back in 2008, and we never have any defaults in the portfolio. We believe that we have to be conservative in the credit to have a strong protection with a bond component of a convertible bond, especially when you have some equity exposure in the convertible bond.
Yes, well, I guess 2008 would have tested your credit analysis there, Arnaud, but it seems like that was a good result there, that you didn't have any defaults in terms of the coupon payments of the bonds you held in your portfolios through that period. So, how big is the convertible bond market globally, and can you actually build a portfolio appropriately diversified by issuer, by country, by industry?
Thank you. That's a very interesting question. In fact, the convertible bond market total value is now above 500 billion US dollar. It has increased by more than 50% since the end of 2019. 2020 has been marked by a very strong primary market. This is, in fact, a direct consequence of a record level of new issuances that we have observed since COVID started, as well as the overall market appreciation following strong returns over the past years. Convertible bonds have always had some biases toward growth companies, sometimes toward recovery companies, but on the global market, it is always possible to find exactly what you want in a portfolio in terms of sectors, in terms of protection, in terms of convexity. So yes, currently the convertible bond market is very well diversified.
Well, that would give me confidence there that as an active manager, you'd be able to appropriately move the portfolio around and highlight, I guess, different industries and countries and thematic trends that you were trying to capture also in the portfolio. So probably not dissimilar to an active equity manager or a credit manager, I guess. How does the strategy perform when markets are volatile? And perhaps can you explain how the strategy went through the global financial crisis, or even more recently in March 2020, when we saw extreme equity market volatility as markets were sold off heavily?
In 2020, convertible bonds did not disappoint. As the sell-off started from the end of February to mid-March, convertible bonds become more and more defensive and show lower drawdowns than equities and high-yield bonds. At the beginning of 2020, convertible bonds were very convex, and as a consequence, they protected with their bond component. But when the rebound started in late March, convertible bonds quickly became more and more sensitive to equity prices and captured the rebound, maintaining a considerable outperformance relative to the global equities. As a consequence, our convertible bond index returned plus 25.4% in 2020 in US dollar returns, greatly outperforming global equities, global high yield. Our strategy did even better. We returned 39.32% in 2020 to our investors. This is explained by the convexity of the asset, and that makes the asset becoming defensive when the markets are falling and capture the upside when markets are rising. Our outperformance is explained by 75% by our picking, by our bond selection, the right company in the right sectors in the good part of the world, and 20 to 25% is explained by the top down, the bigger exposure of our portfolio, as well in equity as in modified duration or in credit risk.
So many retail Australian investors will be aware of the Australian Stock Exchange listed bank hybrid securities, which are a form of a convertible bond, but a key drawback with these securities is that the issuer has the right to convert the bond to equity, subject to trigger events. The equity conversion, as you mentioned, has embedded option value, which I guess from the holder's point of view might be positive, where the option is exercisable by the holder, or negative, where the option is exercisable by the issuer. And this is where I guess Australian issued bank hybrid securities have divided many investors, and as a result, quite a number have shunned these securities because of the perceived negative option value. How do convertible bonds and the type of bonds that you purchase in your portfolio differ from the Australian bank hybrid securities?
Indeed, they are completely different products. First, bank hybrids are issued by banks, while this is a very small sector in the convertible bond universe. Second, and most importantly, they have a different structure. A convertible bond is basically a bond and a call option. So if the underlying equity rise, the convertible bond will rise too. It also means that the convertible bond holder is not forced to convert into stock. It is a choice. When a conversion happens, it is usually a good news, as it means that the stock price has risen and the bond is in the money. With a bank hybrid, an increase in stock price has limited impact. And the choice, like you mentioned it, to convert is not with the investor. It will be forced on the investor if there is a problem with the bank.
So I guess you're just reinforcing there the perceived negative option value in an Australian listed bank hybrid. And I guess whenever you do look through the terms of the bank hybrids and the conversion terms, they're extremely complex. And I guess my takeout has been that the conversion would occur when the equity is falling in value and not rising in value. So hence that negative option value. So I guess it's interesting your comments there. You're focused, I guess, very much where the option is exercisable by the holder of the bond as opposed to the bank hybrid structure there. How can convertible bonds be used in a diversified portfolio, and do you believe they enhance portfolio diversification? And I guess given that we're looking at a security that has bond and fixed interest-like characteristics, but can become equity, I guess it can be a little more of a challenge for investors to work out how to position these in their portfolios.
In fact, convertible bonds have a very strong diversification power. First, they have a performance that is close to global equities with about 30% less volatility over the last 5 years and 10 years. With such a risk-reward profile, it clearly improves the efficient frontier of a diversified portfolio. In particular, because correlations are quite low versus the other asset class, or very different. For example, the correlation of convertible bond with equity will be high. It will be small but positive with interest rates, and it will be moderate with credit risk. So adding 10% of convertible bonds in a diversified portfolio allows to increase returns and to lower risk.
Yes, well, I guess the key point that I guess has come through in my mind from your comments, Arnaud, is that yes, they whilst they are a fixed interest like security and they can be behaving like an equity, they do not trade in line with the movement of the fixed interest market or the equity market. So hence, I guess at a high level, it does occur to me that they've got to add diversification in a portfolio just by having an exposure potentially of 10%, as you mentioned there. So yeah, I can certainly appreciate the benefits to portfolio diversification from using a convertible bond strategy in a portfolio. So finally, is now a good time to invest in convertible bonds based on the assumption interest rates can't go much lower, and hence we're hoping they must start to rise or continue to rise? And what's your outlook then as a result for the convertible bond market?
Looking forward, we have a very positive outlook for equities. And equity is a large part of the performance of convertible bond. And that outlook, that positive outlook, is very strong for the companies still in the recovery phase, who often present attractive valuations. Recently issued, this bond offers the opportunity to participate in the potential recovery while being protected by the defensive aspects of the convertible bond structure. Within the company that have benefited from the lockdown, such as e-commerce, cloud computing, or internet security, we focus on the companies that we believe will be able to maintain a high revenue growth momentum and continue to surprise positively at the next two quarterly earning release. After that, our selection within the technology sectors will be narrowed by an equity valuation basis. As a convertible bond is a bond, we already talked about the credit part. A few words on the credit perspective. We also observe a very virtuous cycles in the recovery names, where a strength of underlying equity will bring significant credit tightening, adding to the potential returns of these convertible bonds. We tend to focus on issuers with the most resilient balance sheet, and we anticipate another wave of refinancing in the coming quarters, which will create potential opportunities. Conversely, if the situation was to deteriorate, convertible bonds have historically exhibited 45% less default rates than traditional high-yield corporate bonds. From the perspective of interest rates, we believe, and we already talked a little about it, that they remain low in the near term, as central banks across regions have adopted very accommodative monetary stances in order to contain the economic fallout from the coronavirus outbreak. In any case, convertible bonds are not particularly sensitive to interest rates, with a modified duration that is around 2 in average. These factors combines in a positive outlook for convertible bonds during the first half of 2021, driven by the continued recovery of the consumers and tourism sectors, as well as a solid performance of specific subsectors of the technology sector, and an overall high level of convexity following a record year of new issue. We anticipate that new issue volume will remain elevated in 2021, especially during the second half, when companies will need to refinance high level of maturities and may require additional financing. This may create some pressure on the valuation of the market, even though it is currently at relatively cheap levels. But we believe this would be balanced by the benefits of increased issuer diversification and higher convexity to the market. So we stay very optimistic on the asset class and in our capacity of our active management to be able to follow the different rotation and the different movement that we will see in the market in the next month.
Arnaud, thank you very much for joining us on the Net Wealth Investment podcast series this morning. I've certainly found it very educational, your comments, your thoughts, your insights into the convertible bond market. And I do note that we currently don't have the Lazard Global Convertible Bond Fund on our investment menu, but I'm sure it's something we could arrange if any listener was interested in investing in the strategy. And I'm sure it's something that I'm happy to have further discussions with Lazard about there. But it's certainly, I guess, an investment strategy, Arnaud, where there aren't a lot of, standalone convertible bond strategies available in the Australian wealth management market. So I certainly wish you all the best for the fund. And as I say, I think it's come across very clear that considering the use of convertible bonds in a portfolio can certainly improve the diversification benefits in the portfolio there. So again, thank you very much for joining us this morning, Arnaud. We very much appreciate your time and your insights. To the listener, thank you again for joining us on the Net Wealth Investment podcast series. I certainly hope you enjoyed the session this morning with Arnaud Brillois from Lazard Asset Management, and I wish you all the best to have a great week ahead. Thanks for joining us.
Thanks for listening to this episode of the Net Wealth Portfolio Construction Podcast Series. For more episodes and to subscribe to our series, visit our website www.netwealth.com.au or visit the iTunes Store or Spotify. We hope you can tune into our next episode.